All right, so has the intermediate pullback started? I'm going to break down some technical signs today that shows that we might be very well be in the midst of one right now, and how deep and where can it go to. We've talked about before, but we want to see if this is actually it, or are we just going to we're going to get another month of a rally out of this. So we're going to break down the charts, see what the patterns are showing us, see what signs are out there. And then we're going to take a look at an area of what's driving. First of all, we're going to take a look at what's driving this market and one of the sectors that have been so bullish and that's starting to roll over and show more weakness than some of the others. And we're going to take a look in that area, in that particular sector, for today's trade ideas. So let's go ahead and get started. Today is Thursday, January the 30th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the rally we've had in the last, today here, the close into the move into the close avoided getting a yellow line again. We got the light pink shading, but we did not get the yellow line. The momentum and near-term lines both came up. The near-term line coming from the upper reversal zone. The momentum line not getting to an extreme high, so it's not that big of a deal. When you look at the intermediate line falling, it's still showing that weak bearish posture, but not dropping below the moving average yet. So weakly bearish. It's still not trend changing. It's still not even really an intermediate pullback until you break that 23% level. This is on an intermediate basis, mind you. You really haven't started a pullback yet, a significant pullback. So you can see, like the Russell 2000. If I were to zoom out here on the Russell 2000, that same intermediate line, see, this intermediate line has fallen below 50. We do have the dark pink shading. We do have the red line. If I were to edit this and bring on that 23% level, the 78% level here, you can see we have fallen below the 23% line. So significant difference there between the S&P and the Russell 2000, where we haven't yet. So we haven't really started the pullback. It's choppy. We're getting bigger days. I mean, you can see from a trading range standpoint, we're getting bigger moves. We've had almost a 1% move there that ended up being 0.9%. Then we did have a 1% move there, 1.5%. And this is on SPX. Let's pull up SPY too. Very similar. Then we had a bounce up of over 1% to the upside. So the volatility is getting bigger. Now, we didn't have that big of a move today in terms of, it was only 1/3% gain by the time it was all said and done. But the range, you can see, was bigger than average. It was more than the 1%. So the more the ranges get bigger and continue to be bigger, the more we move up towards, and crossing above that 1% level is a sign that we are in an intermediate pullback. So we're getting signs. We're not quite there. We're like, okay, things have reversed to the downside, but we're getting more and more signs that we'll get that intermediate line dropping below 50. And remember, once it drops below 50, that's kind of what we're looking for. Then we look for it to find support and bounce up to and make a new multi-month intermediate run like the one we were just on. This one that we were just on that started here in kind of the middle of October, a little bit earlier for the S&P, but about the middle of October by the time that intermediate line crossed above 50 there. So about a 3-month run, closing on 4 months on the S&P 500 that we're not quite there. And you can see, I've said before, the process of an intermediate pullback is not going to happen in a day. It's not going to happen in a week. It's a process. It's going to take a while. You can see we had a pretty big drop right there. This was on Monday, and we've had some choppiness this week, but nothing necessarily yet that's broken through, because there's some support levels, in this area. If you look at the Bollinger Bands here for SPY, you can see that right where that 23% level is, there's some volume support. There's a volume node there. And then once you get down to the 38% level, you can see there's another big, volume node that's going to act as a support level. So we can come down and find support, and we're not necessarily so far up above that any decline is going to be necessarily a free fall. That's a positive sign. And if you look at the DMI, for an example, another kind of sign that this trend, that we are bearish, that we are getting this intermediate pullback, well, we do have to get that positive line to drop below 20. And it's fallen from a high level, but it hasn't fallen below 20. The negative has jumped up, and that's, a sign too. So we've had the negative line jump up, but we haven't had the positive drop below 50. And when you look at, again, like the Ichimoku cloud, despite the pullback, we're still showing a very strong trend, very strong trend. It's kind of hard to free fall from a very strong trend like that. It takes more of a grind for that to happen, and not even just on the daily basis, but even on the weekly basis, we're on a very strong trend. So look for some support as we pull back, as we flirt with these lines. You can see on some of these other intermediate pullbacks, we barely just got below the green line before testing the blue and bouncing back up again. So that's the pattern I expect to see again on this particular pullback. Okay, so before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video if you're watching this on YouTube. That will notify you when these videos are posted. Click the thumbs up icon down below the video. That tells us two things. You liked our video today and you want us to do it again tomorrow. If that's not the case, you don't have to click on anything. Also comment down there on what you got out. What did you get out of the video today? Why did you like it? Why do you want us to do it again? Let us know down there. Join our website at marketscholars.com. There's a link popping out right there, top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos, and join join our Market Outlook Facebook group that we've created. If you're watching us on our website here, through our YouTube video right here, I also invite you to check out our Market Outlook live videos that we do at 3:30 Eastern time. I get a lot of requests to review old trade ideas that we've done and see how they're doing and how to manage them. So that's what I do in these live videos. They're posted here. You click on that link to go to the page. You can also see it too if you mouse over Market Outlook and go to this Market Outlook live trade review. All the archives are there as well for prior live videos. That is a paid product that you get access to with our monthly plan, our monthly plus subscription plan. You get access to those classes, that as well as all of our trading rooms that we have on our calendar. Also engage with us on social media. If you click this heart right here, it opens up a new window. Hit that like button. Same thing with Facebook. Hit that thumbs up. Takes you to our Facebook page. Again, the more you engage with us there, the more the easier it is for they'll promote our content. Those platforms will promote our content to you. They won't always show you all the content that you follow because there's so much, but they will promote the content that you engage with the most. So we try to make that really easy for you here. All right, let's get back to the charts, and you can see on the chart itself for the S&P 500, we are getting a bearish candle this week and a little bit of an upper shadow there. We might get a little bit more of an upper shadow depending upon how bullish we are tomorrow. But we're getting a bearish candle. You can see the trend is changing. We've gone from bullish to bearish. You can see other patterns just like that over here. So, look for a few weeks. I don't think we'll get all the way down to the 200-day moving average like these two pullbacks did. But I think that we'll come down and form a day like that, have a week or two where we're bearish and flirting with the 50-day moving average. And you can see where the Fibonacci lines are there and how far and where we might pull back down to. If that does occur. If you take a look at the three green arrows for the S&P 500, we got the one again on the moving average, so we don't have the yellow line, but you see the MACD and stochastics are still red. In fact, if you look at the two-line versions of those, you can see look how quickly we are right back up above, or close to being above the 8-day moving average. MACD is pulled back down, but still both the moving averages are still in bullish territory despite their weakness there. So we haven't really started this pullback yet. Another sign that we've been choppy and things have been looking more and more bearish, but we haven't really had that exhale. If we were to bounce off of this, it wouldn't be enough. It would be like this one. We wouldn't have enough of an exhale to really say, okay, it's over. Here we go on a new multi-month run. All right, now let's take a look at the intraday moves. And you can see, look at that late rally that came out initially, essentially right after they declared the global emergency with the coronavirus. The market just took off, but you see where it stopped. It's where it stopped last time. There's a significant layer of volume resistance here. Now you break through, then we can go up to 331 easy. But if we hold like we did over here, then expect to move back down towards 323. In fact, you expect resistance to hold until it doesn't. And you can see the range is going to really start tightening up. Look where that has moved. Our low tag has moved up to 320. Here in a couple of days, it's going to be moving up to this day. And after that, it's going to move up over here. And the low tag is going to be there for a while. With the high tag also moving to the left and being left of the low tag for the first time in a while. That will be a bullish, or excuse me, a bearish phenomenon, and we would expect bearishness to come out of it here. Let's look at today's range and volume again and put those numbers into context. Here so the volume was 75 million. So another day, you can see as we've been getting these 1% days, we've been getting a little bit of a jump in volume. If you take a look at today's range, 4.37 points, filling in the gap there. So if you put those numbers into context, then you can see if 75 million's up here, enough to keep bringing the average up. The ATR, the move was over 4 points. That's way up here, enough to bring the average up over 1%. And like I said, crossing back above 1% is a sign that we are getting enough of another one of those signs that we're getting enough of an exhale to say, okay, here we go on this intermediate pullback that we're on. Let's take a look at volatility. And look at that. We jumped in volatility. That's not surprising, but look at the big drop that we had. Again, just barely getting below the 95% mark. So not really breaking support there. So in fact, as we pull down like this, you kind of expect now that we'll probably bounce back up. In fact, I actually think we have another leg higher here before this is all over. I actually think we'll get up to 20 or above on the next near-term run or two to really solidify this intermediate pullback and say that this is enough of one that we can bounce off of. You can see we haven't had enough of one in the past. These have been the intermediate lows, and they all got above 20. So that's kind of the nature of the beast. So we're not anywhere close to that yet, and we're still at 59. It's not surprising that you follow up strong days with down days. We tend to have more down days than up days, but look for an up day to come out of this one of these days. Very similar kind of over here. Look for an up day to come out of it and to get back up above. In this case, for the first time, get above the 20 level. All right, before we break down what's driving this price action, a quick summary on our technical outlook here is, we've had this bullish intermediate run. It's showing some more signs of weakness with some choppiness. We've had some signs that the intermediate run may be in the early stages, or the intermediate pullback, may be in the early stages, but we're not quite there yet. We are in the Russell, but we're not quite there yet on the S&P 500. So we're working our way, and it's a process, and it doesn't happen in a day. So especially when we've had a pretty decent run here of 10+% in a matter of a couple of months. So, so it's going to take a while for this choppiness to lead into that intermediate pullback. But we're definitely in that, we're definitely in that process now. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment as to why. Why do you disagree with that outlook? Why are you more bullish, or why are you more bearish than what we came up with here today? All right, now let's take a look at what's driving the price action today. And if you take a look at the comparison, and you can see going into, this is the last 3 months. In fact, if I were to go out here to that October 8th low in 2019, you can see that we've been on a really good risk appetite move. In fact, all these equity asset classes all up 10% in the matter of that 3+ month period. But you can see, crude oil has been dropping significantly. It had been down well off of its peak, as all these other equity classes started to continue to move higher. But you can see that also you have gold and real estate, long-term bonds were also moving higher too as the stock market peaked. Again, in a kind of a short-term intermediate type peak. Well, if I just look at today alone, because today of all days we had the FOMC meeting, so that's had an impact on the risk trade. And you can see going into that meeting here at noon, things are, bonds and gold were up, and all these equity, crude oil, emerging markets were all down. Well, look at what they did from that move going forward. The safety trade came down, and all these other equity asset or risk asset type classes all rallied pretty sharply. Now, I don't expect them all to rally to new highs here, because I expect the market to have more of an intermediate pullback. We've been seeing plenty of signs of that happening. Of course, nothing's ever 100%, but we've seen plenty of signs of that happening. Right now, it just looks like we've had a temporary pullback, a near-term pullback where the blue line drops below 50. And we might be starting a new near-term run right now before we ultimately get that intermediate decline. And again, any bullish near-term run, I wouldn't expect to last the full 7 to 10 day, 12-day window. I expect it to more last 7 days or less, 3 or 4 days kind of thing before, to see 3 or 4 days before we really, before it pulls back down below 50. So that's what the major asset classes. One thing that stood out to me too for my portfolio management class today is if you look at the 12 biggest economies, it's a sea of pink. Italy's the only one that kind of made it back. You can see it barely got to 50.24. Everything else, you notice the intermediate lines are all falling. With the intermediate line obviously below 50, that's why you got dark pink shading. Those two things are happening. On the other end of the spectrum, of course, you already talked about Italy, but Canada also is holding its moving average with the U.S. So it's a pretty broad rally. I did see something about, a certain percentage of the S&P 500 are in correction territory, but that's not the broadest sense of the word. A broad market technically is small caps, large caps, mid caps, and all kinds of stocks put together. And so you can see here that we, as bullish as we've been over the last month or two, with everybody participating, now you see that everybody is showing some weakness right now. All right, when you look at all the major countries, and you can see how kind of broad the selling has been. In fact, everybody's pretending. You look at, there's dark pink shading all across the board, and red lines all across the board. So it's pretty risk off. The FOMC met. Obviously, that has an impact too, and their decision on Fed policy. Of course, that's going to impact yields, and yields have been plummeting like a rock. Multiple days of clusters in a row. We've seen this before, of getting multiple days of clusters in a row. In fact, if I go out to the daily chart, you can see back in here as we approach 2%, we hit the clusters and went a little bit actually below 2%. We did that same thing here, and it appears that we're doing it here. We came up against a 23% retracement. We hit it for resistance, which means there's a good chance we roll down and hit new support levels. And that's on the daily chart. This is what the weekly chart looks like. All right, not quite the cluster there, but you see the intermediate line has rolled back down. We're back to pink shading and red line again. So we're back to what is a long-term bearish trend for yields, which means it's going to be hard for stocks to be too bullish if yields are falling on the way back down. More of a coincident indicator than it is a cause and effect relationship. Here's the dollar index trying to figure out what it wants to do too. It's had the highest near-term peak that we've had in a while, so a pretty decent bullish run, but not of one to really get this intermediate line going again. So that's the kind of the aftermath of the FOMC as we head into a new week, jobs reports and so forth. Next week with more earnings coming out as well. So that could add some fuel to the fire, so to speak, and continue this trend, or start to look in the other direction. You see a very similar pattern on the actual sector rotation. So if I move to the sector chart, you can see again from a 12 grid standpoint, lots of dark pink and red lines. Look at energy and materials, got the red lines. You can see financials has rolled over. It's gotten a red line. Healthcare is starting to roll over. Those two have been very strong. Technology is still holding up really well. That's your strongest. Obviously, your safe haven trades are also overbought in the short term. Look how far they've extended away from the moving average. And energy getting you the oversold clusters, not surprising. And the communication services giving you light pink shading. Well, Staples and communication services kind of giving you the light pink shading and yellow line treatment. So even these, we're kind of in the early stages, some more than others, of an intermediate pullback across all these different sectors. Just haven't got it quite yet on the broad market as a whole. And if you look at just today alone, so here's noon Eastern time, you can see pretty much everything went up by the end of the day. And staples and financials and utilities and technology and energy were all the best performers. So it's kind of interesting. Those are all, they're not necessarily linked together, but they're all bullish. And some of these have been bullish for a while, and some of them, industrials, which has been bullish, has lagged. Healthcare, which has been really bullish, has lagged. So there is some rotation in and out of outperforming and underperforming sectors, but it's a pretty good sign when you have all these kind of uncorrelated sectors all moving together, and their correlated partners are all down here and the underperforming the broad market as a whole. All right, well, that brings us to our trade idea of the day, and it's actually in that healthcare sector, which is really lagging behind, and that is stock Humana. You can see it's, and again, we've already put this trade on in today's Market Outlook Live session, so take that for what it's worth. But you can see how it's got a newly bullish pattern here. Dark pink shading, red line, easily below the moving average. You can see it obviously has the 3 red arrows, and the 8-day and the 17-day are both crossed below. Both the moving averages for these MACD and stochastics are in the lower half of their charts. It's a pretty significant downward turn. If you look at its Bollinger Bands here, you can see that we've been so bullish that we've got a pretty sizable gap here to fill in. If we were to break this node, it's a pretty sizable gap all the way down to 300, and you have earnings coming up here pretty soon that can add fuel to that fire. If you take a look at the Ichimoku cloud, you can see there's a pretty large cloud that we have to fall down through to get there. And you also see too kind of another gap on the long-term charts, having broken below the 50 and a really big sizable gap down to the 200. So we got multiple kind of quote-unquote gaps that we have to fill in here if we were to continue to be bearish, if we were to break down below these levels and be more and more significantly bearish. Here's the DMI chart for Humana. You can see the negative is crossed back above 25. The positive index has fallen below 20, and you have the ADX already above 25. So we're already, we're going to get some good trending moves out of this because the ADX didn't fall back down below 20 here. So if we took a look at his options, now keep in mind it's got this earnings coming up, and you also notice that, here, let's go back to the chart here. Let me pull this up. You can see by February expiration we can go down to 316. So what we did was we looked at selling the 320 and buying the 325 out of the money, and it's able to help us manage our risk. We can keep our loss to half of that if it doesn't work out. But if it does work out, then for $300 of risk, you're getting $1,900 reward, better than a 6-to-1 reward to risk ratio, with a really small risk if it doesn't work out. Alright, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. Let's keep this conversation going in our Market Outlook forums. Open up any thread with any new questions or comments you have, and reply to anybody else's threads as well. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content in between these videos, and join our Market Outlook Facebook group as well as our community at marketscholars.com. Have a great rest of your evening, everybody, and we'll see you all tomorrow.